shared in this lesson. My name is Cindy Lowe, and I'm one of the financial literacy teachers here at SaskDLC. So to begin with, I'd like to just, show you this pyramid that goes through the different types of investments. And as we go up in the period, we go up in level of risk. So at the bottom, we have more secure ones, cash type investments, highly liquid. Some of them are guaranteed. And then as we go up, we go in growth potential, but we also go up in levels of risk. So I'll explain each of these here quickly. The biggest factors that come when you're choosing investments, you have to consider all of these. Risk is the big one. So what are the chances that your investment will decrease? Very few investments are actually guaranteed. So you have to decide, what risk do I want to take? Could the asset, could the home, the real estate, the stock go down? And if it does, is it going to bother me? Am I going to be okay with it? The can you sleep at night kind of rule comes into play when you're talking about investing. So you have to consider risk, and you have to be comfortable with that risk. It's not dependent on age. Usually it's just a person's own tolerance and what they can withstand. Return is definitely a consideration. So how much return am I going to get? What kind of annualized percentage return am I going to make on this investment? 2% per year, it would be associated with a lower risk investment, but it's substantially different when I talk about long-term goals and planning. If I were to invest in something that would make me 5% or 8 or even a 10% per year investment, there's considerable difference when we figure out the future value of those investments with return. So it is a consideration. It's not the only one, because with risk comes return. So you have to consider that. Liquidity is one as well, is the ability to convert your investment to cash without loss of value. So yeah, you might have access to a stock, you could sell it, but is it down in value? Real estate, have I maintained my value? So you have to think about liquidity, not just can I get my cash, but can I preserve my capital, my principal investment? And then time is the big factor. How much time do you have to invest? Will help determine the most suitable investment. Most of the time for riskier investments, 5 years or longer is considered, reasonable for the stock market, that there hasn't necessarily been a 5-year time frame that there's been a downturn. There may not have been a great return, but 5 years or greater is usually seen as a good rule of thumb for riskier investments. Our safest ones are those bottom tier ones, the savings bonds, savings accounts. Guaranteed investment certificates, GICs, are the only investment that are actually guaranteed. Term deposits is another word for them, where we lock them in for a certain term. And then some corporate and government bonds are considered lower risk, safer investments. The GIC is a big one. That's a fixed interest rate. Typically, it can be redeemable or non-redeemable. So before the term is up, if you lock it in for 3 years and need your money early, you may be able to get access to it at a lesser amount of interest. It has the word guarantee in it, and it truly is the only guaranteed investment. Some newer investments have come out where GICs actually follow the stock market return, so you can have a fluctuating rate, those new ones. So check them out if you're looking for something low risk and guaranteed. The returns may not be as great as a mutual fund or a stock, but you maybe have more peace of mind given that it's guaranteed. Treasury bills are actually sold by the Government of Canada to finance their operations. They're sold every 90 days. They're very low risk. They're considered a parking spot for money. So if you have a short-term money that you want to put aside for, money that you maybe sold a house and have some money, or sold a car and you have this $5,000 or $10,000 you like to put somewhere that's not in a savings account that you can't access with your ATM, you could put it in a T-bill fund. These are mutual funds that are sold. So this is a low-risk mutual fund, but it's all made up of T-bills that are sold by the Government of Canada. Are they guaranteed? No, but they're considered lower risk because they're backed by the Government of Canada. And so that risk is seen to be very low, that they're going to pay these back. They'll just keep renewing them, paying back is what they do. Okay, bonds are an interesting one that people tend to talk about. They are lower risk. The return is interest that they pay on the bond. Usually you buy these in a bond fund. It's another type of a mutual fund where you buy a bond fund that's just made up of a bunch of different bonds. The thing with this one is you're basically lending the company or the government, who's ever selling the bond, money. So businesses may need money, they finance it, but they also can sell bonds. So you give them an investment, might give them $10,000 or $5,000. They use your money to grow their business or the government uses your money, and then they pay you back at a set rate at a time in the future. So interest rates are the biggest factor here. Is if interest rates go up, those bonds tend to be worth less because they're locked in at lower rates. So they do fluctuate a little bit, but mostly dependent on interest rates. And then, of course, something fun to talk about that everyone seems to know lots about or initially have heard about stocks. These are when you buy a portion of a company, you're a shareholder, you could be invited to vote at shareholders meetings, you participate in the earnings if they have any, and the risk could be very low for those big blue chip stocks like Walt Disney or the GM, General Motors, or Coca-Cola, those big companies, to very high risk when you're talking about a stock that is in a sector like energy or oil and gas, or overseas, some markets that are volatile, that have seen to be higher risk. And so it's all over the place in terms of risk. It could be low risk or high. Stock investing allows you to be a stockholder. So you're hoping for the success of a company. And basically, what you want to do is you buy the stock lower than what it becomes. So if I buy it at 20, I want it to go to 30. If I buy it at 50, I want it to go to 100 and double my money. And so stock investing is interesting, but there could be a great amount of risk. If the company that you buy is found to be fraudulent, so there's been stories, Enron, WorldCom, and Nortel, all in the early 2000s, had participated in accounting fraud to cook the books, or so to make their profits look better than they were. And then when the profits looked better, they were able to, share price went up because people thought, wow, these companies are doing good. What ended up happening was there's fraud happening, and they stopped trading on the stocks, and all the stocks went to zero. And if you own those stocks, you ended up with absolutely nothing because you can't trade stocks and no one's buying them in a fraudulent company. So there is some inherent risk that you don't always see what's being reported, what's happening in the company itself. How do you make money on stocks? There's two ways. Number two is the gain on the stock that I talked about. You want the stock to go and trade for higher. But the second way is that profit I was talking about. So if a company has profits, they give some of that back with dividends. A good example is bank stocks. The Royal Bank, CIBC, TD Bank, Scotia, they all have very high profits, and they will quarterly announce a dividend, their profit levels, and then annually, they'll announce a dividend where they give a portion of those profits back per share to their stockholders. It might be 30 cents, a dollar per share, something like that. But it's basically a little bit of their profit that they give you to reward. And that creates demand for the stocks too and creates value. So dividend bearing stocks are the best stocks to buy. They're usually the big companies that are very successful and that have some good profits. So if you're looking for a good stock to buy, you might want to look at a dividend paying stock. The stock market is where they trade. So think of it like an auction market where you buy and sell items, that we're familiar with. This is kind of the same way. It's electronic trading. So I have a stock that I want to buy. I want to buy Apple, for example. I might put in a bid to buy Apple. Someone else on the other side of the world or on the other side of the country wants to sell their Apple stock. So it's a buying and selling where the market is. And so the stock markets in the States are over 50% of the world stocks. There's stock markets all over the world. That globally that trade stocks in their countries around the world. In Canada, we have the TSX. This is a look at the stock markets in the Americas, what's happened since for the last 5 years. And you can see the Dow Jones is the big one in the United States. The S&P is one I want to mention. That's the 500 biggest companies in the United States. So the 84% at the end means over the past 5 years, that's what it's made from start to finish, where we're at. The NASDAQ, the Russell, also U.S. Tech stock markets. The NASDAQ is a tech one. That would be where Amazon is sold. All the technology companies are on the NASDAQ. Russell's a smaller stock index. And then the TSX are a Canadian one. So our Canadian stock market is quite a bit further behind than the US market, just in terms of economy and recovery. You'll see stock market crash there in March of 2020, right after. But if you understand the stocks are in companies that are big, they're Heinz Ketchup or Procter and Gamble or General Motors, we're still wearing clothes, we're still showering, we're still eating food. So yes, the COVID happened, but people didn't stop living in their homes. So we still were consumers. And so if you understand that, you'll see that downturn, that dip, you see dips along the way as opportunities to buy. The stocks are on sale. So if you bought at the lowest of the dip, no one had a crystal ball to say when that happened, but if you were comfortable with that risk and that downturn, you could have bought at a low and seen the great returns that we're seeing today. So understanding the stock market and not being fearful, maybe so, is what people need to know about getting into stocks. Uh, there's two terms we talk about when we talk about stock markets. The bull market is a roaring upward market. Think of a bull roaring up. And then a bear market, we say a downturn. So there's a significant bear market. You'll hear that's a downturn in the market. People are just selling more than they're buying. And it's all about demand and supply and what happens. I mean, sometimes there's world events that affect that. 9/11, the mortgage crisis in '07, Ukraine and Russia's conflict. All of these impact markets. But basically there's usually a reason that it's sentiment among investors where they just want to sell, right? I've made lots of money on Amazon, I'm going to sell it today. And people think, well, what's going on? It's the price is going down. It's sometimes just a matter of more sellers than buyers, or if going up, more buyers than sellers to push those prices up. A stock market crash is one of those significant downturns, and we see those over the years. I just showed you that one. Now, in terms of stock market and stocks, you might want something safer. You might say that's fine, but I'm maybe looking for a safer investment. Mutual funds are one way. So this is where we take all of investors' money and pool it and buy a whole cross section of funds and stocks. Okay, and so the risk could be very low up to very high. This is a look at Royal Bank's mutual funds. There's 319 that they have for sale. How do I know which ones to buy? Well, it comes back to what I said at the beginning: your time frame, your risk tolerance. How much are you willing to invest? Can you sleep at night if it goes up or down? If you want something safe, what are your goals for this money? So I talked about T-bills. If you want to park your money, you could buy one of those T-bill mutual funds. You could buy a bond fund here. I like to show this one. This is a global tech fund that is made up of technology companies, primarily out of the United States. See in the bottom corner here, there's a few companies around the world that we are represented. There's 86 different stocks in this fund. And what I like about it is you can invest in this fund for as little as $500 to get you started. You don't need tens of thousands of dollars. I mean, for example, NVIDIA number 4 here. NVIDIA is, I think, $1,200 US today. They just announced a stock split, but Alphabet's, Google, all of these are very expensive stocks. It'd be very difficult for someone to get into on their own. So you can invest in something like this for $500 and make some money. Now, this investment, I think last time I looked, was well over 10% average annual return, which is a nice, great return to give you good long-term growth if that's what you're looking for. In the short term, I think they make money too, but there's a little more fluctuation. Excuse me. The next one I wanted to show you is a bond fund. These are those bonds I was talking about. They're issued by government or companies. Down here is the return, 4.5%, 4%. Low return, lower risk, but it's an option. And then one I also like to show is this balanced fund. It's sort of somewhere in the middle between lower risk and high risk. You've got a nice mix of bonds, equities around the world, real estate, and an average annual return here of 5.7. So just about 6% is pretty decent. Excuse me. There's also alternatives. You could buy investments like real estate. Again, considering liquidity, return, what am I going to do, my maintenance cost. And then there's all kinds of other alternative investments out there that you should be wary of and buy with caution. So that concludes the overview of investment alternatives. I hope that you enjoyed the presentation and use it to invest your own money.